Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Good morning, everybody. Happy Tuesday. Happy September. It's Tuesday, September 7th, 10 a.m. So it's time for our webinar. I see people slowly coming in. Everybody's shaking off the summer, I guess, but good to see everybody. Can't believe it's the end of summer, but it's a nice, cool morning here in Bucks County, Pennsylvania. Already had to run to the office this morning. They let the contractors in, so everybody's working hard already. So we've got a bit to cover today. I don't expect it to be a long webinar. I'm going to give you some market updates. There wasn't a lot of great information in the analyst report, so I just have really one to review, but we'll give you an update of the markets where they were last week. And we'll talk about our financial planning topic as we always do. And this week it's using a charity or including a charity as a beneficiary. And we're going to talk a little bit about how to use a charitable remainder trust as a proxy for a stretch IRA. So you may remember that the stretch IRAs were essentially done away with under the Secure Act. And that's a real loss for everyone because a stretch IRA allowed us to take an inherited IRA and pay it out over a person's lifetime. So that's gone away now. If you attended my classes years ago, you would hear me say at some point the stretch IRA is going away, and that did go away with the Secure Act. And if you are charitably inclined, and some people are, it makes sense to look at your Roth conversion strategy and your beneficiary designation strategy. So we're going to talk about that quite a bit today, or a bit today. Actually, we're going to have Sarah Brenner from the Slot Group on in October talking about using charitable trusts and trusts as a whole in IRAs as IRA beneficiaries. So let's get into it. Remember, you're muted. You have the ability to use the Q&A section at the bottom of the screen. So type in your questions as we go. Your chat is disabled and you are recorded. So last Wednesday, we had our September special webinar, and that our special guest was Andy Ives from the EdSlot Elite Group. So Andy is one of their analysts, and Andy does a great job. He writes a lot of these slot reports and slot mail responses that I read to you every week and talk to you about every week. And actually both of them today are from Andy. But I think Andy did a really great job of talking about net unrealized appreciation and the pros and cons of it and how it works, kind of the the methods and the operations of it. And I liked his light bulb analogy. And I know I've seen that sheet that he uses before, but every now and then something new triggers, right? And you pick up on things. But I love that light goes on, light goes off analogy that Andy used. So if you missed that webinar, you're going to have an opportunity to see it on our website. We have weekly webinars and we have the special webinars, so you can log into there, you type in your password, or type in your email address, and you'll be able to access those videos. We do have some classes coming up. So the Changing World of Retirement classes, these are going to be online classes again, because we're just not sure what's happening with universities and schools. So they're going to start on October 19th, and they're going to run for 3 consecutive days. So if you sign up for Tuesdays, you would have 3 consecutive Tuesdays. If you sign up for Wednesdays, you would have 3 consecutive Wednesdays, and there would be 2 hours apiece, 6 hours of material. Now, the vast majority of you on this call, I'm sure, have already attended the Changing World of Retirement class. Doesn't mean you can't attend again. And if there's somebody you care about, then I've heard folks say, I would like my brother, cousin, friend, children to hear this information as well. you're going to get an invitation to this. Feel free to forward it. It's online. The capacity is significant, so it's not like we have to worry about jamming everybody into a classroom and having cookies for everybody. So look out for that. Share it with your friends and loved ones, and they can get the same education that you have and have put you on the path that you're on now. So again, we're going to talk about charities as beneficiaries and using charitable trusts and stretch IRAs. So let me just check in before we move on to our market portion. All right, no questions so far. All right, so let me give you your slot updates, and this is going to tie in. This is really actually good because we're talking about in this this first slot report mailbag is asking about QCDs, or qualified charitable distributions. So I'm not certain when qualified charitable distributions came onto the scene. It was about 4 or 5 years ago, but they're relatively recent, and a qualified charitable distribution allows you to take a distribution from your IRA if you're over 70 and a half. And yes, it still refers to 70 and a half because it was prior to the change in the Secure Act. So that's okay. When you attain the age of 70 and a half, you have to already hit that half. You can take a distribution from your IRA up to $100,000 and send it directly to a charity. You don't receive it yourself. You send it directly to a charity, and therefore you don't pay tax on that distribution because it goes right to a qualified charity. So QCD is a really great tool. Husband and wife, of course, if they can do $100,000 each. So if you're charitably inclined, you can use this tool to draw down the IRA for money you would not necessarily use. Now, again, that money's gone. You can't pull it back. You can't use it for your own needs. So first of all, you have to be charitably inclined. And second, you must be very comfortable that you're not going to need that money in the future. So there was a question on one of Ed's. I think Ed was talking about this, Ed Slot on PBS, and an advisor wrote in, and I'll read the question to you. So the question is, I appreciate all the information you pass along, both through PBS and now through the American College. So Ed is, I guess he's a lead professor or writes some material at the American College. American College does a lot of CFP training and advanced designation trainings. In one of your recent presentations, you discussed QCDs, and they're often overlooked value. Boy, isn't that the truth? I recommend QCDs to eligible clients. Since the adoption of the new age 72 for RMDs, the question I have is this. As I understand the rules, people who are 70 and a half or older can do QCDs up to $100,000 annually. But now RMDs don't start until age 72. This is this gap that the Secure Act created. Does this create a split definition as to who can use QCDs? So the writer of this is asking, do you have people who are RMD age 72 and people who are age 70 and a half, and there's a split definition? And it's really not a split definition. It's just once you attain the age of 70 and a half, they didn't make that adjustment for charitable or distributions. They made that the adjustment for only RMDs. So Andy writes back. Andy Ives, who you all met last week, is the author of this letter back to this advisor. He wrote, Charles, you are correct. The qualified charitable distribution, QCDs, are only available to those IRA owners who are 70 and a half, age 70 and a half. You are also correct that RMDs now do not begin until age 72. So he's given them lots of reassurance and praise. I like that. By raising the RMD age to 72, the Secure Act essentially created a small window of time where a person could do a QCD and not be subject to RMDs. While QCDs are typically used to offset RMDs, an eligible person can always do a QCD for more than the RMD, up to the 100,000. The same essentially holds true for those who are between the ages of 70 and a half and 70. They have no RMD, but they can still do a QCD. So what Andy's saying is you don't have to wait until you're age 72. The current rule says age 70 and a half. So even though you don't have an RMD, and this was really designed to be able to take RMDs and send them right to charities if people didn't use it. But listen, the rule changed. They raised it to age 72 RMD, but the QCD still stayed at 70 and a half. So no logic and from government often, but you can still take advantage of it. So you have an extra year and a half where you can take advantage of that. Maybe that may be, and for most people, probably be 2 tax years where you can send another up to $100,000. Now, it doesn't have to be $100,000. If you just wanted to send $10,000, whichever works for you, you can do that as well. All right. So now the next one is refers to what was called a mega QCD. So Ed referred to this mega QCD on a discussion, and the author writes, "My wife and I recently watched your interview on Morningstar," and that's where it was, Morningstar, "and you introduced a mega QCD. Both my wife and I are currently at age 69, so we're not eligible for QCD this year. However, it seems like we are qualified to make a mega QCD contribution in 2021. We would like to use our IRA money to make charitable contributions of $120,000. We have questions on how to report the mega QCD on our tax form. Hopefully you can help us to clarify." So this is different just for 2021 because of the CARES Act. So there is no such thing as a mega QCD. This is a term that Ed came up with, and he writes, "The mega QCD is not a true QCD, nor is it an actual product. Mega QCD is just a catchy name, Ed thinks, that we gave to a charitable contribution tax strategy that is only available for 2021. In the past, taxpayers could deduct annual cash donations of up to 60% of their adjusted gross income, or AGI, for that year. That this 60% limit was waived by the CARES Act, thereby allowing up to 100% of cash donations to be deducted. However, the waiver will expire at the end of 2021 when it goes back to the standard 60% limit. The mega QCD strategy is nothing more than a cash distribution from an IRA or company plan of an unlimited amount and a subsequent donation of that unlimited amount to charity. The IRA or plan distribution will be reported on your 1099-R. This is his question, how to file it, and will count towards your AGI on your tax form. However, you would be able to show an itemized deduction of the full amount of your donation on Schedule A. Note that a taxpayer taking the standard deduction cannot itemize a charitable deduction, and therefore cannot benefit from the mega QCD strategy. So I said a lot, but that last line is very, very important. Most folks, when they come to us, they're claiming the standard deduction. So the QCD, an actual QCD, allows you to send the distribution directly to charity. So even if you're claiming the standard deduction, it still works for you. What Ed just said is this mega QCD, as he called it, does not work if you're not itemizing. So if you're only itemizing to take a charitable distribution, it may not make sense for you. So you kind of have to do a mock tax return to see if it works for you. But that's a very, very important point that he just made, because people get really caught up in these, these fancy strategies for getting things out, and this timeliness of, well, it's just available for 2021. If you make this distribution and you don't realize that it's not going to work out the way you did, often these can't be undone. So I see a chat. We're supposed to be disabled. Sorry. All right, I disabled the chat. I got this from somebody. I don't even know what it means. So put it in your questions if you don't mind. I'm not understanding what the chat that you put in there means, but I'll make sure that I Zoom update it. We have a new software update, and I guess it took off the chat disabled. So I know that's confusing about QCDs. Back to QCDs. That mega QCD is not a real QCD. Like Ed said, it's just a catchy name that they came up with. Now, what about last thing for the slot report today? What about real estate in an IRA? We hear this sometimes. I'd like to buy a beach house. I'd like to buy an investment property in my IRA. Can you do it? Yes, of course you can. There's a lot of things you have to pay attention to. So jumping into it, Andy writes, tread carefully. Owning real estate in an IRA could create the possibility of a prohibited transaction. And we're going to talk in a bit about what happens when you have a prohibited transaction. You cannot vacation at the beach house if you have a beach house. You can't change a light bulb at the apartment complex yourself. To keep an arm's length distance, it's best to have all repairs, rentals, and general upkeep handled by an independent third-party property manager. Any fees owed to the property manager must be paid by the IRA, as payment with personal funds would be a prohibited transaction. These can get very, very difficult, but people often, a few times a year, someone will say, I'd like to buy an apartment building. I'd like to buy a beach house. And I hear, again, this is kind of like the mega QCD. I saw something on TV. Someone talked about it, read about it on the internet, that I can buy this in the IRA. So the prohibited transaction rules can be complicated, and if violated, an IRA account owner will find himself in a world of hurt, Andy writes. The entire IRA is deemed to be liquidated. I want you to think about that for a minute. The IRS says, okay, you did this prohibited transaction. Maybe you just paid your homeowners association fees from your regular checkbook instead of from the IRA that your property is held in. Well, the IRS could say, well, that's a prohibited transaction. Now the entire thing has to be undone. So the IRA is deemed to be liquidated. When you liquidate an IRA, what happens? You pay tax on it. The tax qualified status is lost, and any tax and penalties will be based on a full distribution of all IRA assets. But prohibited transactions are not the only issues an IRA owner needs to be concerned with. Here are 5 general items to consider when the IRA owns real estate. First is creditor protection. It talks about owning it through an LLC within the IRA. How about liquidity? A house is not a liquid asset. You can't, he writes, you can't cut the porch off and take it as a distribution. When an IRA owner only has only real estate in his IRA, he better find some liquid asset to withdraw if he's subject to required minimum distributions. And we all are subject to that at a certain age. Currently, it's age 72. Since IRA RMDs can be aggregated, one option is to take the RMD from another IRA with more liquidity. So maybe you have your vacation home in your IRA A, and you've got, $500,000 in IRA B. So could you take your RMDs from IRA B and satisfy both? Well, sure you could. If you have your vacation home in IRA A and you have an old 401k, that's 401k A, could you take your RMDs for both of those from your 401k? No, you couldn't. So again, getting complicated. How about valuation? Speaking of RMDs, how are they calculated? Well, RMDs are calculated the December 31st balance. So the year before balance in your IRAs, that's how we figure out how much your required minimum distributions are. How do we do that for a home? Well, or some kind of real estate, then it has to be valued every single year, and it has to be a third party, or certainly should be a third party valuation company that does that. And that independent property appraiser has to be hired and paid for by the IRA account. Again, if you write the check out of your checking account for the valuation of that property, that's a prohibited transaction. He talks a bit about rollovers. If you wanted to roll that, say you have a custodian that's handling that for you, and there are custodians that will handle real property assets in the IRA, but you want to roll it over to somebody else, you can't do it. It's got to be a like for like rollover. You can't roll over cash for the IRA. So it's got to be you got to be very, very careful when you're moving assets, real estate from one account to another. Now, how about selling the property? A full cash sale is easy, but what if the property is sold and financed? Some people say that. I have a client who wants to sell a large piece of property they have, and they said to me, well, if you know anybody, I'd love to hold the note. What does that mean? Well, they don't want to have the entire realization of that sale. So they'd like to hold financing on that, and that allows them to delay tax on capital gains. Can you do that with an IRA property? Well, I'm not so sure. A full cash sale is easy, but what if the property is sold and financed? Now there's a promissory note. So now you hold a promissory note in the IRA. What's the value of that note? What if the property buyer stops paying? An entirely new set of questions have now been introduced. So moral of the story is, yes, you can do it. Be very, very careful. You really have to make sure you've got all of your I's dotted and T's crossed all along the way throughout all of the account ownership or the investment ownership on that. All right, let's talk a bit about the markets. So how did we do last week? The week ending, what was that? September 3rd? Yes, it was September 3rd. Well, the S&P 500 was up for the week, 0.62. Mid caps and small cap stocks were down about 0.20 and 0.36 respectively. The Dow Jones Industrial Average was down 0.14. So this is we talked about the differences between the S&P 500, Dow Jones Industrial Average, and all the different indices, quite a few months ago. But this is where you see the difference between the Dow Jones Industrial Average ending the week down 0.14 and the S&P 500 ending the week up 0.62. And year to date, the S&P 500 is up 21.94%, almost 22%. Dow Jones Industrial Average is up 17.10%. So that doesn't mean that the S&P 500 is always going to do better than the Dow Jones Industrial Average. It just depends. Things kind of toggle back and forth. Many more companies in the S&P 500. So many more opportunities for it to rise and fall. The NASDAQ was up 1.57% for the week and still up 19.77%. No big glaring changes for the week that I'm seeing. It was a really quiet week going into Labor Day. That's why I actually just got this market update from Invesco about an hour ago. So everybody's still a little bit on catch-up mode. The one analyst report that I thought was interesting was BlackRock. So BlackRock has this BlackRock Investment Institute. They refer to it as BII. And I'll read this to you. So they're just talking about the cyclical business cycle and why it's a little bit different than normal cycles, the COVID cycle. The BlackRock Investment Institute has long held that the path out of the COVID-19 shock is not a typical business cycle recovery. They refer to a chart and they say the shock is more like a natural disaster. So what we're seeing isn't just a normal dip in business cycle where we have people who are laid off and now they're coming back to work. We have a slowing of demand and now a pickup of demand. They're saying it's more like a natural disaster. Well, that makes sense. It's a global pandemic coupled with a global recession. So there's certainly a lot to deal with in that. Activities temporarily shut down and is rapidly coming back online. There's still a sizable shortfall to cover to get total U.S. employment back to pre-COVID levels. We're seeing that all over. One of our busiest restaurants that we pass all the time on our bike rides had a sign that says closed down until further notice because they can't get staffing. And I know it's because they can't get staffing because we went on the website to see what the story was, and that's what they had said. We believe a tapering of the Fed's asset purchases starting this year would mean the central bank's response to inflation will remain very different versus the past. We talked about what tapering was last week. Remember, it's just really the Fed pulling back from issuing bonds and buying them back. The markets are likely pricing in a first rate hike in late 2022 at the earliest. So that's talking about the Fed raising rates. BlackRock is saying the markets are likely pricing in a first rate hike not to be until late 2022. BlackRock thinks it's not going to be until 2023. So think that interest rates are going to stay about where they are, at least from a Fed point of view, and until 2023 from a BlackRock standpoint. Okay. Riverfront is still talking about now's a great time for active management, which may be, but they are an active managed portfolio manager. So you got to take that with a grain of salt. So, okay, let's talk about how these charitable beneficiaries work and for IRAs and what the benefit could be. So I'm sorry, before I move into that, let's just talk about portfolios. So everything's kind of humming along nicely right now. But don't forget that things can correct very, very quickly. And we always want to be defensively optimistic. So you know my answers for this: asset allocation, principal protection, and account segmentation. And if you need it and it makes sense for you, guaranteed lifetime income. So you do want those pillars in place and you want that strong foundation. If we suddenly see big drops in the market, you just want to have your investments protected. So you're funding in the years that you need, the early years of your retirement, and you've got some level of principal protection. So I'm going to switch to my whiteboard. So raise your hand for me if you can see my whiteboard. It just simply says, if charitably inclined. That's what that says. All right. And I have listed QCD, beneficiaries, and CRT, which is charitable remainder trust, and stretch. So you're going to see me looking down because I'm moving my tablet down so I can write on there. So let's just draw out our boxes. You know, we like to do this just to remind you that everything fits in these three boxes. We have taxable, tax deferred, and tax advantaged or tax-free. So taxable, of course, are your anything outside of your IRA, right? Your traditional IRA. So your CDs, mutual funds, stocks, cash, whatever you have in your bank accounts, your brokerage accounts, that again, outside of an IRA. And you get 1099s every year for this. And those 1099s trigger tax. You have to pay tax on that, whether it's long-term capital gains, short-term capital gains, dividends, interest. You pay tax on all of those things. And then how about your tax deferred? Now, this is typically what we say is that, first of all, we want 6 months to 1 year, remember, 1 year in this bucket here. So we want to keep that amount low enough so it's not producing too much. Actually, we're going to make this dollar signs, not producing too much in tax, because it's going to kind of cascade out and affect other things like your Social Security or just your general overall tax rate. So we want to help keep that as low as possible. That's why we want to keep 6 months to 1 year of expenses. And your tax deferred are your traditional IRAs and retirement plans and 401ks. And we typically say that we want to keep this low enough so that an amount left in here is low enough that your required minimum distribution is below your standard deduction. And if your required minimum distribution is less than your standard deduction, then you don't pay any tax on that. And that's a good situation to be in. So that's the basic premise of the tax efficient strategy. And then everything else pushes over to this tax-free bucket, right? So anything extra from taxable goes to tax-free, and anything extra from tax deferred goes to tax free. And then when you draw money out of here, you don't pay any tax. And also your heirs, they don't pay any tax. So we often go through a lot of work to determine how much you should be moving each year from your IRA to your Roth IRA. Because remember, there are only two things that are truly tax-free, and that is anything Roth and properly structured cash value of life insurance. So we do a lot of work to do these conversions, converting money from traditional IRA to Roth IRA. And we have to figure out how much you're going to do each and every year to do that conversion, have it not be too much tax for you to pay in 1 year, and have it balance out for the time that we potentially have left. But what if you say, well, wait a minute, and I'll just use an example. We had a client we were looking through, and we determined that they have about $1.4 million in today's dollars that they'll likely never use in their retirement. So how do we get that number? And we had a discussion on the phone with their attorney. How do we get that number? Well, we do that through financial planning. So we go through a really extensive process, and I've told you that the platform we use, eMoney, they've told us time and time again that they hardly see financial plans as extensive as ours. And I'm proud of that, because we give our clients expense spreadsheets to fill out so we know exactly what they're spending. We spend a lot of time talking about what expenses they're going to have on the horizon in the short term, longer term, and midterm. And then we get a real solid idea what their investments look like now and what they're going to look like. We use account segmentation to make sure things are funding correctly. So it's really an exhaustive process, and it gets us to this comfort level of, at times, what I think is a significant amount of money that people may not need during their lifetime. Now, think about that. That's in 2021. If you're 65 years old, by the time you're 90, really, this was a huge number. I think this grew to about $15 million. So in this case of these individuals, they don't have children. So some of that was earmarked to charity. Now, this became a new conversation during the financial planning process and during an inheritance. But even if you do have children, you might say, well, listen, if we're projected to have, say, $10 million, let's use 10 million, keep things easy. I've got 2 kids. I think it's okay if they each receive $3 million. And the remainder, I'd like to go to a charity, because whatever it might be, $4 million to go to some charity. I'm just throwing numbers out there. So you could now let me back up. So that begs the question, well, if we have $1.4 million in today's dollars, does it make sense to convert this? And we know we're not going to use it to Roth. Convert to Roth. Whoops. Well, you might be surprised to hear me say it may not. Because if you know that you're never going to use the money and you know that it's going to go to a charity, why should you pay tax on it? And then the charity receives it tax-free, because they would receive it tax-free no matter what, whether it's an IRA or not under the current rules. So, but you have to be really, really confident in this. So some people might say, okay, Mark, well, I know you say it's $1.4 million, but I want that million just in case. I want that million just in case, we live a lot longer. Just in case we need a lot more care. We've already fleshed these things out, by the way. We've already, looked at the potential care, and we've got insurance policies in place for that. And we've got other things. But what if they said, okay, we want to keep $1 million aside? Well, we still have $400,000 here that if we didn't go through this exercise, we might convert that unnecessarily. So it may make sense to not convert that money. Keep it in your traditional IRA here. And you could still not pay tax on it if you're charitably inclined. So how would that happen? Let's jump into that. So first of all, here's our tax deferred bucket. I'm just doing tax deferred. Let's just, for example, say that we have $400,000 in there. Well, Mark, there's something that comes out at age 72 called required minimum distributions. And you said that you want to keep that below your standard deduction. $400,000 may make this higher than our standard deduction if we have other income. But if you're charitably inclined and you're keeping this money in here just in case, remember we can use that QCD rule. So for the amount that's over, the amount that's going to affect you, let's just say you wanted to do $25,000. This is all just for discussion. You could send via QCD $25,000 a year direct to charity, cannot stop in your bank account, and not pay tax on that money. So while you're holding this money for potential future use, you decide not to convert it to a Roth IRA, you're still not paying tax on that money because you could take it out as a qualified charitable distribution. So that's really easy if you don't have children or you just have an amount that you want to set aside. So let me just pause there and see if we have any questions. Okay, no questions. What if you have, you first want to leave it to your kids? So let's go back to this tax deferred. And I'm not going to get too deep into this. Now let's go back to the $1.4 million. Well, what if you say, well, I have the amount that we're gonna create the Roth over here, tax-free. And let's say you got $3 million sitting here in your Roth. So you take it out, zero tax, and your heirs, no tax. So that's good. And then you might say, well, I've got $1.4 million and I'm probably not going to use during my lifetime. I want the kids to benefit from that, but I want the remainder to go to a charity when I'm no longer here. Now that's where it gets a little more complicated. So, but you can use what's called a charitable remainder trust. And there's some other variations that you can use, but let's just talk about charitable remainder trust just in the simplest way right now. A charitable remainder trust allows you, when you're no longer here, to pass these funds. Let's just say it stays at $1.4 million to keep things easy, to pass these funds to a charity at death. This is at death. Oops. That money stays in the charity, right? No taxes paid at that point. and the income comes out to your child or children. So let's just say, and it's usually 5% a year. So that would be about $70,000 a year. So about $70,000 a year would come out now from the charitable remainder trust. That would be paid out over the child's lifetime. So it's whether the charitable remainder trust works or not really depends on the potential age. But that is also kind of a backdoor way to a stretch IRA, because think about what I just said. This IRA money gets deposited into the charity. They pay a percentage every year, and they pay it while that child is alive, and then they hold on to that money when that child's no longer here, very simply stated. Now, there's some drawbacks. Your child can't just reach in and take more money. So you've got to make sure, maybe they're receiving a couple $1 million from your Roth IRA here, and this is something extra, but it's a way to kind of replace the stretch IRA rules. And if you've had money that you identified that you are going to pass to charity and you don't necessarily want to convert to a Roth IRA. I know that's complicated, but I just wanted to have that discussion today. There are ways of dealing with things other than just converting to a Roth IRA or funding life insurance. Those are our first best tools. But if we get to the point where you're charitably inclined, or not even get to the point, I guess you could get to the point, because you could be 80 years old and you say, okay, well, now I have X number of dollars here, which are much larger than I thought they were going to be. Things have maybe changed with your children, or you've already gifted, or it's more than you think you should. So things could change, but very, very few people I've found will do things, will gift to charities just for tax reasons. If you're charitably inclined, you're charitably inclined. If you're not, you're not, and that's okay too. But anytime someone talks about charities with me, we always pause and say, well, wait a minute. Wouldn't it be a shame if you're going to just use this 1.4 million again? If we weren't paying attention and we were just on this freight train of Roth conversions, wouldn't it be a shame to pay tax on that money that nobody's ever going to need, that needs to pay tax on? Nobody needs to pay tax on that money if you're going to send that to a charity. There's a lot of exploration, as you can imagine, it goes on in there, because, again, you may need those funds. I'm not talking about gifting during your lifetime. I'm talking about gifting after death. Gifting during your lifetime is a whole other big commitment. And yes, you can set up a family charitable foundation. There are people who do that, and they leave their money to that charity. The kids take income out of those charities, and there are certainly things that you can do like that. That can get really exciting stuff, really exciting. There's a few things you need. So number one is charitable inclination, right? You gotta want to donate to charities. Number two is a really good attorney. You have to have a really good attorney who can help you with this, because it's not something you just draft and let go. These rules change a lot over time. So you should review these. How often? Once a year. Does that mean you have to engage your attorney every year? No, but you want a good attorney. You want a good certified financial planner helping you with it. And four, you want a good CPA. So you should have these no matter what. But to go down this road of looking at charities, don't just do it for tax reasons, because you might just get yourself in a bad situation or something that you're unhappy with. You got to first really want to donate to charity. And it doesn't have to be all of it. It can be a portion of it. It could just be, if you've got a few $1 million, it could just be a few $100,000 that you eventually want to go to charity. But again, let's have that discussion, because wouldn't it be a shame to convert that money that never has to be taxed? All right, I don't see any questions. We're going to end it there a smidge early this week. It's 10:39. It's been great seeing you again. Enjoy it's not fall yet, but it is the end of the summer. So I don't know what comes in between. I know it's not technically the end of the summer. I think that's the 22nd, but for all intents and purposes, summer's over. I look forward to seeing you all next Tuesday. You'll have an opportunity to schedule an appointment with me if you'd like to at the end of this webinar. I hope you have a great week, and we'll see you soon. Thanks. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.